If you're interested in checking out TradeNet, they currently have a sale on their base package, the intro package, where you can get it for 30% off at $350. And that package comes with a funded account with $14K in buying power with a $700 max loss. But there's no PDT rule, and so new traders specifically can day trade as much as they want without necessarily risking what they would if they deposited thousands into a regular broker. And so for new traders, I think it makes a ton of sense. And if you're interested in checking that out, I'll include a link as well in the description. And so thanks for watching and enjoy this video. Okay, so before we get started with this class, let's go ahead and break down what the moving average crossover is. So this is basically using two separate length moving averages and waiting for them to cross over each other to determine our entry. The basic logic behind these is that when the long-term moving average crosses under the short-term, it signifies a bullish or upward change in direction. And when the short-term crosses under the long-term, it signifies a bearish or downward change in direction. In this video, we are using the 12 EMA as our short-term moving average, which is the blue line, and the 26 SMA for our long-term moving average, which is the white line. And so basically, when the white line crosses under the blue line, it signifies an upward move, and when the blue line crosses under the white line, it signifies a downward move. Makes sense? Feel free to replay that last part if necessary, and I apologize in advance for any volume changes. Let's go ahead and start. As the name suggests, it is a scalping strategy for only the first crossover of the day and only in the first 30 minutes. Usually this seems to work much better the first move of the day. You know, a lot of times what you see after the first crossover is you see a lot of consolidation. You know, you'll see a lot of the time it will cross over and then it'll cross back under and then back over and back under, and it'll kind of stay there consolidating, kind of faking people out that are probably jumping in there for a decent amount of time. Another thing you see is that if you don't see it within the first 30 minutes, typically, you know, those follow-up crossovers do not work as well. So like the ones I've really been attacking are the first crossover moves of the day, and specifically, like I said, within the first 30 minutes, those seem to work the best. It's not ideal under all market conditions, and so, you know, I think that AMD, the microchip sector, has been pretty volatile the last few weeks, and so I do think that's helping, and so I think volatility is a benefit of this strategy as well. And like this says, it seems to work better when a quick reversal or a high of the low or high or low of the day break happens. I've been testing it on AMD. AMD will push up, it'll spike up originally at the open, you might get that first candle to spike up green, and then it will quickly reverse and then break the low of that first green candle and just start washing out down. And that's typically when it works the best. You usually see at that point the moving averages will converge and cross under each other, and you know, you get a really nice breakdown that is really good for scalps. You know, the way I've really been playing it with AMD is I've just been giving myself about a 1-to-1 reward target is really what I've been giving myself. Just about a 1-to-1 reward target, depending on the range of the previous day and, you know, overall the range of the stock that I'm trading. With AMD, most of the time my reward and risk is about 10 to 15 cents. You know, that's usually what the range is. That's usually a good risk reward level for AMD, considering the range. And so risk reward, like this says, the risk reward is subjective. Some people can use different levels. That's just what has been working with me, letting that 1-to-1 level really work, because the accuracy is really what takes care of this strategy. It's not necessarily, you know, I know a lot of people with this strategy were talking about how you could potentially get in and then get in when the crossover happens and then hold for the next crossover. But I think sometimes that's going to give you worse risk reward. A lot of times, you know, it's just going to quickly turn it back on you. And so I think that gives you a little bit worse risk reward. Although I'm not saying you can't approach it that way. It's just not the way I've chosen to approach this strategy. But yeah, scalping method works for this as long as you're strict with it. And, you know, I guess you could probably set stop losses in there. But the scalping method works. Give yourself 10 to 15 cents of reward, you know, 10 or 15 cents of risk, and just let the high accuracy profit for you. That's kind of what I've been doing, and it's been working pretty well. Like I said, the first thing that I really noticed about this is that the first crossover of the day seems to work the best. It seems to work the best. You know, you can see a good example of it here. It says, notice how the first cross of the day within the first 30 minutes worked really well. You can see it right here. And again, this is exactly what I was saying in the last slide, that a lot of times we're seeing a nice green spike on AMD and then a quick reversal breaking the lows down here. By the time this actually crosses over, let me get the pointer out. Gapping up into resistance makes the play more choppy early morning. Yeah, for sure. And that's one of the things that you'll see when it doesn't work, is usually when it's just very choppy. Like, you can use the VWAP with this. You can look to see how much the stock is crossing over and under the VWAP. And that can kind of be a good indicator on hopefully how choppy or how, follow through it's going to be that day. I've noticed the first crossover of the day seems to work extremely well. You can see this low of the day break here, and by the time we actually see the crossover play, we're going to be right around this low of the day. Sometimes we're going to be right above it, or sometimes we're going to be right under it. But a lot of times, right when we see this crossover actually follow through on demand, and we'll go over it a little bit more when we actually do a few of these on demand. But by the time we notice this crossover, it's usually going to be down here, and this is really good confirmation. And so you can set yourself like a 10-cent risk, right around here, which is also basing it off of this risk, and really write it down here. But again, what we also see a lot of the times with this strategy is that these second crossover plays don't really work that well. And, like you can see here, it kind of crossed up, looked like it was going to shoot up long and then cross down. You might be able to still kind of scalp these, take 10 cents, and then be done with it depending on when the crossover happens. But I think a lot of the time, the stock is just exhausted from this big move. I think that's why these don't work as well, is because you can see, this is just a big move right here. By the time we finally get down here and it climbs back up and you see this crossover play, the stock's just a little exhausted from this big downward move. You can see it was really nice trend in here, and the more it separates, the more defined the trend is. And then when it starts to get closer together, that's when it actually starts to test it, if that makes sense. And so, but yeah, I think that a lot of times the stock is just a little bit more exhausted by the time it gets down here, and so the second crossover play just doesn't work that well. The first one seems to be much better and seems to work a lot more than the first one, and that's just something I've noticed. And so yeah, so I did a little bit of minor back testing with this one. In the last 3 weeks, we have had 11 successful instances of this scalping strategy and 4 failed ones. So 3 weeks is 5 trading days, and 11 successful instances, and like I said, 4 fails. That seems to work better on the downside, although this might be indicative of a long-term trend more so than it just working more on the downside. Another thing it really could be, guys, that, one of the reasons I like to short is because panic is typically a stronger emotion than hope. And so I like shorting because I feel like they break down quicker than longs spike up a lot of the time, if that makes sense. And so that's another reason, considering it's a scalping strategy, that it may actually work better on the downside. And so it's just a theory. I'm not 100% sure, but it's just kind of a theory there. With the method I've been using, kind of the scalping method, I've been using around 10 to 15 cents for risk and reward. With 500 shares on paper, which is really what I've been doing each morning on the stream, that averages to about a gain or loss of about $50 to $75 on average. Now, there have been times where I've gotten frustrated, not any lately, but there have been times I've gotten frustrated and held on a little bit too long, and the loss on paper turned into 120 or so. But I think the most I've lost with this, with 500 shares consistently, is about 120 bucks. The good thing about that, and this is something that you want to kind of review when you're paper trading, is how consistent even your losses are, your wins and your losses. You want to keep those pretty consistent so it's easier to test and it's easier to analyze. If they're not consistent and they're all over the place, you're not going to know if the strategy is really not working or if you're just not holding it to the proper levels. And so you want to keep your risk pretty consistent overall, as well as your reward target. As I said in the previous slide, I have been using a 1-to-1 reward to risk ratio. This makes it so that my winners and losers are roughly the same size. The profiting factor of this trade is simply the high accuracy. Lately it's been super accurate, and like I said, ideally the first fade has been the one that works much better than all the others, and so I kind of ignore all the other ones now and stick to that. Again, like I said, it has to do with exhaustion and extension at that point, depending on when the second crossover happens. And so that's kind of the big determining factor in it. But it typically works fairly well, and it's almost to the point where I'm going to start using live money with this. And so we'll see what happens. like this says, though, you can use your stock's range to determine your average risk and reward target. If it's too tight relative to the stock's range, you may get stopped out too easily with a 10-cent target. And so basically, like, I've been using a 10 to 15-cent target, but if you buy Apple and try to give yourself a 10-cent target, you're going to get stopped out immediately as soon as you get in the trade. If anything, the spread on Apple might be 10 cents. And so obviously you want to analyze the range of the stock. You know, with this, I've usually, since I'm really attacking the open with this, I've just been looking at the previous day's range. And we'll go over that a little bit when I'm doing the on-demand examples, but building a trade plan class, you know, you want to analyze these things and use that to determine your appropriate share size relative to the range of the stock. If the stock has a big range, you could scale down and give yourself a little bit larger reward and risk target. If the stock has a small range, you can scale up and give yourself a little bit tighter reward to risk target. And so it all depends on what the range of the stock is, and that should always be the determining factor on what your share size is, how much your risk, or, you know, what your share size is really.
One of the best tools you can really get under your belt is learning how to adjust your risk for the price range, or kind of you could say the volatility in the stock, so that you can take the same kind of risk in your trade dollar amount, but change your share size to adjust to that. Let's say you normally do 10 cents, cut the shares by half and do 20 cents, or you can do even more, cut it to a fourth, and you can go all the way up to like 40 cents. And so that's the key of kind of learning how to adjust to price difference. And there's nothing wrong with having, let's say, a 40-cent risk, but your profit is $1.20.
Right.
There's nothing wrong with that. There's some traders that actually trade better when they trade for bigger range of price, so that they get that big reward when they do win. You got to know your style.
And depending on how big your risk is and how big, you know, your reward target is, if you got a big risk and a big reward target, then you can scale down a little bit because you got a little bit more room, and you're ultimately going to make more profit and a bigger loss if you do get stopped out. And so that's a habit each trader wants to condition themselves to have. It's like, okay, you don't just kind of randomly pick a share size in your head. You analyze how much the stock's actually moving. You analyze how big your risk is and how big your reward is. Like, if you only want to risk $100 and your risk is 10 cents, you know, you can buy 900, 1,000 shares and be super tight with that, and you're going to lose 90 to $100 if you get stopped out. You know, if you had a 20-cent reward target, you're going to make 200, so it's fine. But you want to let that determine how big of share size you want to take. This is an example of, like I said, so this stock SQ had a range the previous day of $3.50. So a huge range overall. If you tried to only use a 10-cent target, like risk and reward with this, you would have easily been stopped out on what would have been a very successful crossover scalp. You know, a lot of times, guys, what we're seeing with this crossover strategy is that we're seeing that these are the fades that work the best. You know, it's really when the stock picks a trend early. When a stock picks a trend early, these are the fades that really follow through nicely. But if you're using 10 cents or too small of a target here, you're going to get stopped out on what would be a really nice moving average crossover play. And so that's what Mitch and I are talking about, is you want to analyze this before you just jump in, because it's ultimately going to help guide you on how big to set your risk, how big to set your reward target, and stuff like that. And so we're getting pretty close to the crossover move here. Again, since, say we're in this trade, say if we're risking 15 cents, okay, say we wanted to risk, less than $100, we could effectively buy 500 or 600 shares and risk, $60 to $75 with this trade with 10 to 15 cent risk. That's kind of how you want to do it. We know the range, we know our risk. In this case, since the range is a little bit bigger, we can use a 15-cent risk and reward target. And with that, if we want to risk $75, around $75, we could buy 500 shares. That's reasonable. One thing you want to realize, guys, is that since this is a scalping strategy, I don't want to necessarily tell you to size up, but the way scalping works in general is that you're going to use larger sizing with scalping, holding it for less amounts of time, and then take advantage of the positive accuracy, the high accuracy. And so with scalping, you're going to use larger sizing than you would with a non-scalp trade, and you're going to be holding it for less. And that's going to compensate for the bigger sizing. So since you're taking bigger sizing, you're going to want to set a tight risk and you're going to want to hold it for a smaller period of time, protecting you a little bit more in the trade. That's what scalping is about. And so with this, we know our risk is 10 to 15 cents, and we can patiently wait for the crossover. All right, so now we're actually seeing the crossover is very close to happening. All right, so the crossover, you'll see a lot of times they'll happen pretty quick here, okay? So our entry is 24.84, and we're going to risk, where are we going to risk in this trade? But in this case, with 85 cents, we can risk the whole dollar of 25. And if you extend that to the left here, you do get a lot of confirmation there as well, plus it's a whole dollar. And so that's really where we're risking 15 cents. And then our reward target is going to be, let's see, we're getting at 84, 85. We'll just say 85 to make it easier. Our reward target is going to be right here around 70. All right, so our risk is 15 cents and our reward target is 15 cents. So we're just keeping them even here. Let me take this off. So we're just keeping them even. If our entry's here, you can see 1, 2, 3 squares, 1, 2, 3 squares. And so you can even use these squares to kind of analyze, you know, make sure they're even. And that's actually what these are for. And so you can see 1, 2, 3, 1, 2, 3. All right. All right, well, let's fast forward it here. I tend to prefer to use these with a simple one-to-one target. But I have been kind of scaling out of them on the stream, and I think that's all subjective. All right, and so there we go. All right, so we can look at the range from 74.60 all the way up to 75.9 or 76. Okay, so we got 74.60 up to 76. What's the range? The range is $1.40, guys. So from 74.60 all the way up to basically 76, just to make it easier, about $1.40 range. So we know it's a bigger range, a little bit bigger than the last one, and so we can use a 20-cent target here. So that means our risk is going to be 20 cents and our reward target is going to be 20 cents. And the reason we do that is because the range on SQ is ultimately much bigger. It's a much more expensive stock. And so with that, we have to give ourselves a little bit more room to let the trade work. If we try to give ourselves a 5 or 10 cent risk in this situation, we're going to get stopped out a lot of the time. A lot of the time, we're just going to continue to get stopped out, and it's going to backfire on us. And so in this case, we want to give ourselves a big enough risk and reward to profit with. And so in this case, we're going to use a 20-cent reward target, and we can get this rolling here. And like this says, if we want to risk $100, we can use 500 shares. If we want to risk $200, we can use 1,000 shares. And so that's what we ultimately want to do, is depending on what we're okay with risking, that's the appropriate share size to take relative to the reward target and the risk we gave ourselves. And so if we buy it with 1,000 shares, we're going to be risking about $200 to make $200. If we buy it with 500 shares, then we're going to be risking about $100 to make $100. All right, so this kind of shows you watching the crossover here, and the crossover can happen really quick. There's the crossover. Okay, so we're in with 700 shares at 76.43. Okay, what was our risk in this case, guys? What was our risk and our reward target? It was 20 cents, and so our risk is... We're in at 43, and so our risk is 23 right here. And our reward target is from 43 up to, what is that, 63? There's our reward target. And I do recommend writing them down and documenting them so you can see it and give yourself kind of a specific target for you to take. And then we're out, and that's it. And so we got our reward target. We got in on the crossover play when it was viable. We took it, and we're out. And this is how you have to do it with scalps. Again, like Casey mentioned, this is a momentum strategy. And so you're taking advantage of momentum in your favor. In order to do that, you have to be quick with these. You know, hotkeys are definitely a plus, and hotkeys are something that will probably help you a decent amount in these type of trades. But at least for the way I'm approaching it, you have to be pretty strict, all things considered, with your risk and your reward in this trade. If you hold on to your reward a little bit too long, of course it might work sometimes, but other times it's going to quickly reverse on you, and so I think it's easier just to be a one and done trade.